Herzlich willkommen bei der Edelstoff Media. Ich begrüße Sie vom Private Banking Kongress aus Köln. Wir sind im Deutschen Sport- und Olympiamuseum und ich freue mich auf ein Gespräch mit Richard Geller. Er ist verantwortlich für die Growth Equity Strategien bei Loomis. Sayles. I'm affiliate von Natixis and now I have to switch to English. Warm welcome, Richard.
Thank you.
Thank you for joining us here in Cologne. We're talking about your equity strategy and especially about your alternative strategies or your long-short approach.
Yes.
What we've seen the last 2 years was a tremendous rally at the S&P 500, 20 plus in 23 and 24. What does this kind of rally means to you with an alternative and a long-short approach when everything is going up?
Yeah, no, it's a good question. I mean, the fact of the matter is the presumption that people have is that anything less than fully exposed in a rally is going to have some cost. And in fairness, there is an opportunity cost loss in not being fully exposed to a market rally. But the cost comes with certain benefits. Cycle over cycle, we expect that the risk-adjusted return that we're able to create in the long-short structure allows us to, in fact, prosper cycle over cycle over the long term with the sorts of behaviors that we're looking to create in the fund. The strategy itself is not meant to necessarily be lockstep with the marketplace. In fact, not at all. The idea is to create a consistent behavioral experience with particular parameters in place and to do well in different kinds of markets, rallies and setbacks as well. So we're really trying to kind of provide an experience for the investor that is consistent and consonant with the expectations that we've set forth in the beginning. And that is really ultimately to create S&P-like returns over the long period of time while providing less beta in the portfolio and a significant driver of alpha as well as capital protection in times of weakness. When you bake all of that together, you get the experience of what our strategy is meant to do.
With your more long-term focused approach, what do you think about the market noise of the Mag7?
Yeah, it's again an interesting question that we get asked about regularly. I want to point out a little something about the Magnificent Seven. The Magnificent Seven have only recently been christened the Magnificent Seven and labeled that. There were periods of time that they were far from magnificent. In fact, if you take the year immediately preceding the first Mag7 rally and you combine that with the first year of the rally, the total return over that period of time doesn't look nearly so magnificent. So these labels can be somewhat misleading. I also want to point out the fact that some of these names, not all of them, we've owned in our strategies for very long periods of time. We've identified them early as very high quality companies generating very strong cash flows long before the market decided that they were magnificent. So the recent experience can create a veneer of specialness that doesn't necessarily honor what has been going on in these companies for a very long period of time.
When talking about markets or about a rally of a market, we can divide between a more junk-driven rally or a quality-driven rally. In which kind of spectrum are we right now?
It's always easier to decide that with the benefit of hindsight. And it's also the case that not all markets are binary in their nature. What we can tell you is that we're frequently asked, is the market expensive or is the market cheap? We don't have a view on the market. We have a view on individual companies. And at any one time or another, these companies may trade at valuations that we think are discounted relative to our estimates of intrinsic value or more expensive. And if they're more expensive, they may represent an opportunity to be short these companies.
So you still find quality with a reasonable price?
Well, it's funny because the quality at a reasonable price sounds a little bit like growth at a reasonable price. At the end of the day, what we're looking for is quality and growth at ridiculously discounted prices on the long side.
Yeah.
And we want the absence of those things to also correlate with an overinflated estimation of what's going to be happening for that company on a forward-looking basis. That's the distinction and division between that which we might be interested in owning on the long side versus that which we might be interested in shorting from the over-expensive side of life. So the fact of the matter is the interim movements of the marketplace are only relevant in the sense that they cause the pricing of opportunity to change, sometimes en masse and wholly, but more importantly, on individual stocks that could be interesting to us. And our job is to take that opportunity as and when it presents itself and determine if that is an optimal opportunity for putting into the portfolio, be it long or short. What I can tell you about the distinction between quality rallies and junk rallies is that we generally tend to do well when good judgment is being ratified in the marketplace. And there'll be moments in time when that's not happening. That's what we call a junk rally. And junk rallies may in fact go against us because good judgment is not being compensated for at that moment. Lower quality, overvalued, highly levered businesses may be going up faster than their brethren that are less expensive, not nearly as geared, and ultimately very high quality over the long term. In those sorts of environments, strange things can happen, but those might also be opportunities presented to us where we can in fact set shorts. When lower quality, overvalued companies exist, that presents a chance for us to actually access them. So the sword cuts both ways is what I'm wanting to tell you.
Can you imagine to put one of the Mag7 stocks on your short side?
It's an interesting question. We have two different kinds of shorts in our long-short strategy. We have shorts that are basically companies that we think are on the wrong side of history, that are basically overvalued, low-quality companies that are trading at price-implied expectations that don't make any sense. And those are companies that we might not be willing to own at any price, right? Those are companies that lack the kind of quality and growth that we're looking for. Now, on the other side of life, we also have what we call opportunistic shorts. And opportunistic shorts are largely valuation driven. They may in fact be companies that represent interesting quality and growth characteristics, but the price implied expectation that the market is making that company at that moment is beyond perfect and therefore unrealistic. What I would like to say, a company that trades through perfection, and we may be willing to short those companies. Now, I will tell you, that doesn't necessarily mean that there are sacred cows that we would never be short. But on bias, it so happens that many of the Mag7 and their brethren are really high quality companies. Whether or not you like them at this current price is a different story. That's what makes the market. But typically, we would perhaps want to see something that is a little bit, less heavy to good quality and good growth characteristics.
Let's have a short chat about AI.
Yeah.
When you're looking for growth companies, do you sometimes see or do you find growth in a value market while AI drives those value companies to some kind of growth area?
Right. This is a hypothetical that's hard to get your arms around. I think that maybe I'd rephrase the question in the following way. In what way is AI changing the fabric of the marketplace and maybe the fabric of opportunity? It's one component of many, is what I would say. There's no question that AI is having massive ramifications on business and industry, and then ultimately what is perhaps appealing to you as an investor. But it's not unilateral, number one, and it's not affecting all markets and all companies the same way. So I would say to you the following, that it is one ingredient that perhaps affects the long-term trajectory of a business in terms of its quality characteristics and its growth characteristics, but is far from the only thing. So it's one thing that needs to be factored in to the mix when examining companies, examining enterprises, and seeking conclusions as to whether or not this company meets the kind of characteristics that we have in the way of meeting quality characteristics, in the way of meeting growth characteristics. I think it is one additional variable.
Okay. Talking about the development in the asset management industry, we see a tremendous demand for ETFs.
Yes.
And you mentioned financial behavior. Does this rush into the ETF space gives you an, let's say, opportunistic point of market inefficiency?
You raise a very interesting point, in many ways the great debate. And the fact of the matter is the following. Some people somehow feel somewhat offended by the inclusion of lots more people, lots more actors showing up in the market, that somehow it's distortional. And it may very well be distortional. We're not offended by that. Our view is bigger, more active marketplaces with lots of participants should be welcome. And they should be welcome for the following reason. Market participants bring what we'll call behavioral bias into scope. And behavioral bias is actually an enormously helpful thing. Behavioral bias is also something that doesn't get arbitraged away. It is a perennial evergreen quality in the marketplace. And the kinds of biases that I'm talking about are things like short-termism, allocation inefficiency, greed, fear of missing out. The more people who can bring those biases into the marketplace, the more likely that the price of opportunities will actually be mispriced with greater regularity, with greater frequency. and therefore give us more opportunities, more bites at the apple to comment on companies and decide whether or not those companies are trading at price implied expectations that are consonant with our views or disconsonant. We're looking for disconsonant to actually create opportunities to invest. When the market disagrees with us, there could be something to do, either on the long side or the short side. So that is to say, in summation, the more people, the better, because that means the more likelihood of mispricings can exist.
Thank you very much, Richard.
Thank you for your time.
Vielen Dank fürs Zuschauen. Wir wünschen Ihnen eine entspannte Zeit.